Good afternoon, everyone. Well, that was fantastic, Jonna. Thank you so much for putting a wonderful agenda together. And from my perspective, having sustainability as a key discussion point at a conference like this is a real turning point. It is incredibly important. I think it's been, someone mentioned the word checking the box, all of those things. But underlying all that is an incredibly important regime and milieu that is going to be increasing and increasingly important. We've seen some tremendous data points from the HR and from Jonna's presentation on how critical following and taking advantage of these requirements are. And as someone who comes from the other side of the Atlantic, and Russell in his presentation alluded to some of the politicization that's happening over in the US, nonetheless, despite Texas and Florida banning ESG as an investment criteria, it's becoming more and more important to US investors, especially those that have operations in Europe. Having said that, I find probably from an investor perspective, the data at least that I am led to understand, probably 20%, 25% of investors from institutional investor perspective care about sustainability measures, and that's not very much compared to Europe. Having said that, most institutions have a very sophisticated it's too long a word for me, have a very sophisticated way of gathering and putting together their data. So I think that the subject that we have today is very fascinating, and we've got some excellent panelists to discuss this and give us some insights, which hopefully will give you all some nuggets to take away and think about and maybe help you in your roles. So without further ado, I'm going to ask our panelists to introduce themselves to you so that they can put themselves forth in the way that they'd like you to understand them and their roles, and then we're going to proceed with a few questions, and hopefully we'll have some time at the end for some Q&A for folks and be able to dig into some of these issues. So without further ado, I'd like to introduce Ruben, Steve, and Martin. I'm going to start with you, Ruben, to introduce yourself, and then we'll proceed with the panel.
Good afternoon, everyone. I'm Ruben Portanier. I'm a partner at GTG. We're a law firm and advisory firm specializing in the technology space. Naturally, gaming is one of them. And over the past year and a half, we have also established a particular service line in assisting clients with ESG and the CSRD compliance.
Thanks, Ruben. Good afternoon, everyone. My name's Steve Myers. My background is in operations corporate. For 13 years, I was MD of a company called Genting for the EMEA region. I then set up Praxis Consulting, and all my work, despite previously being in land-based, is now in iGaming. And guess what? The issues are largely the same. Martin.
Thank you. My name is Martin. I'm CFO for Betsson. And I've been working with Betsson for more than 5 years now. Prior to that, I held CFO positions in other industries. And the way I kind of come in contact with a lot of the ESG questions is when you meet investors, both on the equity side, but also on the debt side when you're raising capital for companies. And this subject is becoming much more important for everybody nowadays.
Thanks very much. And full disclosure, Steve and I are colleagues in a new initiative called Fintel Sustain, which is actually all about creating ratings and rankings for the regulated gaming business to allow a deep dive into the industry to understand its position and be able to present itself to the investment community writ large. So, let's start with you, Martin, and based on your comments. How important, you started to speak about the sustainability and how important it is. Maybe you could elaborate on that a little bit and give us perhaps some data points around how it's impacting Betsson and how you see it formulating itself in the future.
I think if you start like a little bit back, ESG was important, but it was not a criteria that you needed to fulfill. It was good if you managed to do that. But what we see right now is that to start with, it's a lot of investors that cannot invest due to ESG restrictions. But the one who can actually invest in our industry, they are really thorough in their analysis, and you need to be well equipped, and it's very important. And normally, if you go out and would do some form of fundraising, the investors do thorough due diligence financially, but now they do the ESG analysis as well, even more thorough. So it is important. It is something that is top of mind for many investors, and I don't think there's one single call with investors that you don't touch upon this.
Very good. So, Ruben, so companies ignore ESG directives at their peril. Perhaps you can elaborate.
Ignore, you mean?
Companies ignore ESG directives at their peril, based on what Martin said.
Well, I see it in a different fashion, in the sense that over the years, and I agree with Martin, the process was an evolution, a step-by-step approach towards embracing ESG. The pressure, however, came with regulation, especially from a new perspective, with the advent of CSRD. CSRD does capture a limited number of organizations directly. However, there is a huge domino effect that many gaming companies are not yet realizing is going to hit them. It's like a tsunami, whereby you're going to have the organizations which are captured by CSRD, namely banks, for instance, financial institutions, large gaming operators such as Betsson, whereby they will have the obligation to obtain metrics across their value chain from both their suppliers and even to whom they're supplying to. So, I think that the awareness is growing. If you had to ask me that question maybe 2 years ago, my answer would have been different, and I would say yes, there's a complete disregard to what ESG is all about. But the awareness is growing, also because of the fact that some of the smaller organizations that are not captured by CSRD are still indirectly being hit. So just a few weeks ago, we had one of our clients that actually sent us a questionnaire sent by their bank, asking about their CO2 emissions, about their labor conditions, etc. And the bank saying, listen, if you don't reply within 3 weeks of us sending you this questionnaire, you risk that we're going to close down your account. So it's becoming also, that pressure is also mounting on the smaller operators, and they're starting to realize that no, ESG is a thing that is going to stay, and it's not a fad.
So Steve, given that and given that situation that is existing, how do companies turn these obligations to their advantage as opposed to having them as a burden?
Okay, well, I'd like to think of it, to get sustainability to be taken seriously, it's really about monetizing the thing. And how do you do that? It may mean by the investor pool staying the same size. That could be a win, with the regulatory pressures and everything that's happened, Sweden being the epicenter of that, Martin, as you know. Also, cost of capital, allocation of capital surrounding that. There are things we can do. The problem the gambling industry has got is the fact that there's no united front like other industries. So if you take alcohol, for example, they all report in a very similar way. They look at the Sustainable Development Goals in the same way. They talk with the United Nations. They create initiatives with them. There's a lack of consistency across the gaming industry in terms of all of that. So in part, it needs to get its act together so that everybody starts initially reporting on a similar basis, so that when things come along like regulatory settlements, there is a position with regards to that and things can be done. Because what happens at the moment, things are looked at in isolation. So if someone gets a regulatory settlement, what happens if they're a publicly listed company, share price drops, on the announcement of the investigation, then the amount they're going to be fined, it drops again, there's pressure on the share price. These are tangible things that are happening to companies, and we've seen with a number of companies recently that it can take up to 2 years to get a regulatory settlement in place. All that period, all the talk, all the headlines, whenever that company's mentioned, is about that particular action that's going to happen. So I think when you look at the ratings agencies with regards to this, it's quite superficial in terms of how they look at it. And also, a lot of the analysts in particular and some of the funds don't believe it because of all the arguments around greenwashing and everything else. So I think it's important that, I think what can be done, and you mentioned regarding Vintel Sustain, is taking open source data and looking at that in reality, which is really a barometer of how a company performs, rather than it telling you how it performs. So I know some companies, they say we've got the best responsible gambling product, but then when you actually look at the detail, you say, you may well have it, but tell me why. There's no detail there to substantiate and back it up.
You raised several interesting points. I wonder, Martin, if you could comment, when you think about the regulated gaming sector and how it reports on sustainability, do you look at other companies and do you feel there's a disadvantage from an inconsistency of reporting in the sector and that institutions don't know how to think about this business because of that?
I think that's a very good question, and that is something we discuss quite a lot. Jonna, our head of sustainability, we talk about this a lot. And I think the gaming industry, there are a few things that are very important part of the ESG that you need to focus on. We heard Edward talking about responsible gaming, and that is kind of the main thing for us within this. I think the industry is developing. We did an exercise just recently to see what are the other listed companies focusing on when they report. If you go to the financial part, you can look at defined KPIs. That is commonly known. Everybody knows what to look at, and everybody shows the same. In this area, it is not like that yet. Many companies try to describe kind of the same things, but they do it still in a different way. So sometimes it's very hard to get the standard, and that's why I think you need to put even more effort into this going forward and streamline this, because it's important for the entire industry.
Okay, so Ruben, maybe you can comment as well, because you alluded to the CSRD compliance and how lumpy that is so far. What are more specifics around the prices companies will have to pay for not being compliant, and how do you see that unfolding? Because for both public and private companies, depending on how they evolve and their size, there's some serious penalties. A couple of things. One, it was alluded to the fact that it's the cost of capital is higher. A lot of M&A can fall apart, so even smaller private businesses that may not be able to think very clearly about how to report on sustainability will have to, because otherwise they won't get through due diligence checklists that lawyers are requiring them to do. How do you see that evolving?
Well, there are two sort of direct effects that result out of the CSRD. The first is what type of enforcement will be applied by the relevant authorities for those who are not going to be compliant with the CSRD, and that is specifically just for those who are actually captured by CSRD. And it's still a bit of a question mark, because the enforcement framework is not yet very clear, although the CSRD framework has been issued and it is actually enforced at the moment. The enforcement part is still a bit of a question mark. However, there's another cost which has nothing to do with the direct enforcement element, which is the cost of you not being compliant with CSRD, rather than the cost of being compliant. The cost of not being compliant means that if you are a company that is seeking an exit, even though you may not be a large company, if you do not actually have the right framework in place, the right ESG framework in place, that you manage to collect all the data points that you require in order to report, for then when there is an acquirer that does a due diligence on you, can obtain that data, there is a big chance that that exit will be postponed forever. Um, the cost of not being compliant may mean that, as you rightly mentioned, there may be some deals, some acquisitions that do not actually happen due to the fact that there may be a disconnect between the buyer and the seller. We might have a buyer which is, all out for making sure that their rankings on Refinitiv, for example, are quite high because that also affects their share price, etc., etc. And they don't want to acquire a company that is so low in the rankings that it will actually bring down their own rankings. So this has become a very important element, which we see on a regular basis when we are helping on regulatory and legal due diligence when there is an acquisition going on. And we've seen also postponement of companies, the companies postponing their listing efforts because they do not have their ESG framework in place. Being listed requires you that you have to have a proper ESG framework in place, which is also compliant with CSRD. So that in itself is also a cost, because if you have to postpone your listing by a year or so until you manage to get your ESG framework in place, you can imagine what that can have in terms of capital requirements on the company.
So, Martin, just to turn to you on that subject, because you acquire businesses, you go and you do due diligence. There was a data point, again, it was out of the US even, that I think it was a KPMG report or something to that effect, 60-something% of M&A transactions with private companies fall apart because of failure of sustainability tests in due diligence. How has that impacted you, and how do you think about that when you're approaching an acquisition, especially with some of the exotic markets that we all work in regulated gaming?
I think that's a very important question, and again, it comes down to what part of the sustainability that is important. And the same way as you do due diligence on the personnel when you buy a company, on the financials, on tax, on legal, whatever it might be, you need to do it on ESG as well, and especially on responsible gaming. Because if you buy a business ending up with bad procedures in place, no control of AML, no control of responsible gaming, you might end up with a case where you have a customer database that you can no longer use, because our standards are something very different from what the company you acquire. And if they have not had that in place and the framework in place, that is something that you then need to kind of price in to what you pay for this company. And if you haven't done that exercise properly, it can be really costly for you.
Yeah, and so companies, especially private companies who are worried about a million other things, unfortunately are going to have to worry about this if they're looking for a liquidity event that's an exit or an IPO, as Ruben was alluding to. So Steve, what are some ways that companies in regulated gaming can think about, weaponizing the whole sustainability movement, and what are some of the things that companies should be thinking about to take advantage of these reporting requirements as opposed to thinking of them as a burden?
I think if you've got a small to medium-sized company, you're looking to be acquired or have some exit event, then, as Martin said, this goes to the point of valuation and multiple you're going to achieve. Or you can face a situation where there's a knockdown in price because suddenly something comes out of the cupboard that no one was expecting. We've seen a number of legacy issues in the industry over the last 5 years in particular, where companies have been bought, they've completed the transaction, then 2 years down the line, guess what? They've not integrated the platform properly, or other issues have arisen, and suddenly they've got the regulator on their case with regards to the company they've bought. And that depletes value substantially in terms of that. So those kind of issues are really important, and it makes sense, despite what the forthcoming CSRD requirements. It's just good practice in reality to be able to do that.
So I'd like to, and does anybody else have any comments on what Steve mentioned and the whole idea of weaponizing? I know weaponizing maybe isn't the right word, but it's optimizing is perhaps the better way to put it. These reporting requirements, it's very costly for companies to adhere to them. I think instead of looking at them as a burden, they have to be looked at as an opportunity to optimize. So I don't know if either of you have comments on that.
coupling on what Steve was mentioning, let us call a spade a spade. The gaming sector is considered as in stock. So being in the gaming, being a company operating in the gaming sector is already a big disadvantage if, for instance, you are listed. So you have to convince the investor pool out there that you are a company that cares, a company that has responsibilities, that is compliant, does not exploit people. These are all elements which are then very important in the context of the gaming sector because we are disadvantaged as a sector. So definitely the weaponizing analogy, I think, is very opportune for the sector because by actually embracing and showing that sustainability elements and ESG aspects are being embraced by the company can actually overcome the negative aura that there is around being a sin stock.
I mean, to me, sustainability means that you're in there for the long run. And to be in there for the long run, you need to make profit long term, not just here and now, long term. And in order to be that, I think all this that we have discussed is very important topics because if you don't have the processes in place, if you don't do the right things, if you don't take care of your customers, if you don't take care of the system, have a proper business ethic, etc., in place, then you will not be there. So this is a very important long term to be there, to deliver profitable growth in the future.
Yeah. So those are very salient comments. I want to turn to something we alluded to earlier, which is, sin stock. This is a fact that we all live with in this industry. But Steve alluded earlier to a comparison with the alcohol industry, which is another sin industry. Steve and I co-authored a white paper a few months back where we looked at some of the factors that related to how regulated gaming was looked at relative to other industries. And one of the key things which we've talked about is a lack of unity in terms of what are the sustainability factors that this industry looks at. We found in that white paper, and Steve, you can elaborate on this, that companies tend to focus on the things that are important to them, which is great. However, the next company will either focus on something else entirely or nothing at all. Whereas the alcohol industry, if you look at the leading players, Diageo on down, focus on a very consistent set of criteria. So when they're approaching the public markets, the equity allocators, when they're approaching institutional investors, fixed income analysts, and all of these people, as Martin alluded to, have very sophisticated ways, taking in lots of data points of viewing this. There's kind of a price to be paid. Sweden was a big example for us in the public markets when the Swedish institutions decided that they wanted to focus on ESG, and the regulated gaming, or the gaming industry writ large, was re-rated down and hasn't recovered from that at all. So there's some very serious things, that serious costs of not having a more unified approach in this industry. What do you gentlemen think has to happen for this industry to be able to get its act together collectively, to be able to present a unified best foot forward? Because let's face it, investors look at this industry as an industry as much as they may look at individual companies. And so therefore, there's a price to be paid from not having that as a feature. Anyone want to comment on that?
Unfortunately, our sector has always been characterized by not being unified. The sector has always struggled in trying to find a common goal and work towards that common goal together. If we had to look at when I was involved in Brussels, at the time, about 20 years ago, 15 years ago, about the freedom, the EU freedoms, the sector was quite not unified. And the consequence of that was we then now experience that there is regulation in every country. Unfortunately, the sector has always been not working as a team, as opposed to the alcohol sector. So possibly maybe the alcohol sector had a more structured way for many more years than the gaming sector had. But we see, very strong lobbies. The alcohol lobbies are very strong at Indian institutions. And notwithstanding, for example, when looking at sustainability, the damage that the alcohol sector does on the environment is far superior to that of the gaming sector. And yet, however, they have a better picture out there when it comes to sustainability. So there needs to be a leader in the sector that actually manages to unify everyone. As I see it today, there isn't yet that leader.
There's something quite exotic about gaming, I think, which I always tell this story. When my kids were younger, we'd meet up with the parents now and again. We'd go out for dinner and start, what do you do? I'm a lawyer. What do you do? I'm an accountant. What do you do? I work in the gaming industry. And suddenly all the table turned and looked at you because no one understands what it is.
Everybody in the room understands that.
It's got this reputational dilemma. It's continually having to be on the defensive all the time. It can never get all the good stuff, and it does a lot of good stuff, It can never really get that message out for firefighting all the time, and that's a real issue for it. And that's where I think the comparable with alcohol is that 20 years ago, and it took them best part of 20 years to change their reputation, started to do that. The CEOs got together and realized they couldn't continue in that vein and fashion. And I think we're at that light bulb moment for the industry as well at the moment. So they got together, they got working groups together, they engaged outwardly, which we as an industry, and I'm very supportive of the industry, we've not done. So I think that's a real starting point. Now, in reality, the perception of that industry has changed completely, and they're sort of, when we look in reputational terms, they're really the flag bearers compared of the sin stocks, and they've really been consistent in that methodology and reporting. The reality is there are still significant issues created by drinking, more so because of the exponential growth compared to gambling, although there's been exponential growth there as well, but the two, massively different size markets. But, they've managed to get away from that perception piece so they can talk about other things. At the moment, we can't do that, and that's why we need to invest in looking at some consistency of data, consistency of reporting, talk about the good things the industry does. So, for example, I think Egbert, Martin was here earlier, Egbert did some research across all of Europe and different standards. So you could look at that chart and say, well, actually, if one of the companies in this room plays to that particular market, they're doing certain things. And, I compare this with opening a bank account. If you want to open a bank account, you can literally, in 10 minutes, you can open up a Revolut account. It's far harder to open an online gambling account than it is a bank account. Yet the banks are always looked at, in some ways, as the standard compared to gambling companies. So that's a reality, but that's something people just don't know.
Well, it depends on whose data you believe, but you hear about a 2% problem gambling and 10% problem alcohol. And so comparatively, that's, one data point that, is focused upon. Martin, we've talked in the past offline about the financial differentiation between regulated gaming and other sectors. Although one thing I will cite is since the different flashpoints that have been transpiring around the world, weapons stocks have suddenly been re-rated upward because as opposed to weapons being viewed as bad, they're now viewed as, I don't know if the word is good, but more important. So I don't know if there's a flashpoint that will affect gaming, but do you have any data points? I mean, what is the financial impact of improving the perception on the part of allocators, this sector, or even from a company perspective, in terms of cost of capital, in terms of liquidity, in terms of valuation?
I think this has changed over time. If you go back maybe 5 to 7 years, multiples in the gaming industry was much higher. I would say the risk was much higher back then because you did not do the same compliance work as you do now. I choose to see it from the positive side. It's a fast-running industry. You develop a lot. Compliance is getting much better. But still, multiples are much lower today than it was 7 years ago. When you go out on the capital side and look for capital, there's always different metrics that you look at and that you pay for. And basically, that's the underlying risk. You've paid for the financial risk, which is like what most companies do only. And then when it comes to gaming companies, you also add the ESG risk on top of that. So if we, Betsson as a company, would go out and try to raise capital, based on the financial metrics, I would say we would go out as an investment grade if you look at the bond market. But then when you put the ESG on top of that, you probably need to add 1 or 2 percentages on top of that. And that's quite a big fee to pay for where we are today, I must say. Because something that I commonly hear when you go to the banks, they, before you can open an account, as you said, they do a thorough due diligence of us and look at all the procedures. And then when they are done with this, they say, wow, you are fantastic. You have a better procedure in place than many of the banks. You have better control of AML, you have better control of everything. So I usually take the teams down to Edwards and Appo and the operational team here in Malta. And when they leave, they are just can't believe their eyes. But still, you pay quite a high fee for just being in this industry.
So that implies this tax for being in a poorly perceived business. It's in the hundreds of millions or billions in aggregate. If you look at all the companies that are operating in terms of cost of capital, that capital could be circulating inside the industry and growing it as opposed to being outside. And so that actually helps a little bit frame the price. Very important point. So it's funny, so we talked about this being the first time that there's one of these kinds of events inside a conference. I can see this as a very much more exciting, growing business. It's been fascinating to see the Betsson sort of case study here for everyone. I think we have to wrap up, but do we have time for a question or two? Okay. Is there any questions or comments from the audience? Here we go. Please.
You mentioned the ways of sort of driving ESG through the cost of investment and so on. What do the panel think about some of the things that Russell said earlier? I don't know if anybody heard that, around the perception that ESG has for both employees and for customers as a way of driving the gaming industry or any industry towards greater compliance with the ESG sort of principles and procedures.
I see ESG as a super opportunity for the sector. ESG can, if embraced and done properly, can change the perception of the sector. The sector can actually start finally boasting and putting it out there on the good things that the sector does when it comes to responsible gaming, when it comes to AML and inclusivity in the sector. So those are all elements that with an ESG framework, the sector can now start showing the external world that it is not as bad as it looks from the outside. That has the consequence that it can also attract more talent because, the Generation Z, we've seen the presentations earlier on, are much more aware of sustainability issues. So they would want to work within a sector that actually promotes sustainability. So that is also going to eventually decrease the cost of recruitment and of retention. And from the customer point of view, again, the Gen Z is the future customer. So in that case, if the sector is viewed as being a responsible sector, it's going to attract more business. So yes, Martin described that it is a high cost at the moment, between 1% to 2% more. Eventually, in the long term, it's actually going to, in my view, it's going to pay off.
I would add that I think you can't just look at ESG in isolation. I think you need to look at operational and performance issues relative to that, which forms this whole sustainability piece, really. the people who work, iGaming is quite a young industry, and I think, companies will be driven by the ethics of people in those companies, and the younger generation do want to see companies behaving as they want them to behave. And I think that's just a matter of life and, fact of life, really.
Well, we are between you and your lunch, so we won't do that. I'd like to thank Jonna for putting a fantastic day together. Thank you, Next Valletta, this amazing event, for taking this issue seriously. Thank you very much to our panelists, and thank all of you for attending. Have a great day.